Heads up, this video is sponsored by Webull. Deposit $100, get up to $1,600 in free stocks and life insurance below in as little as 5 minutes. Hey everyone, me Kevin here. In this video, I'm going to explain what the Federal Reserve just said regarding interest rates, stocks, and real estate. Many of you already know that the pumps we've seen in the real estate market, and probably or almost certainly the pumps that we've been seeing in the stock market, have been heavily influenced by super low interest rates. When we can cheaply borrow, we tend to invest more money. Heck, when M1 Finance sends you a beautiful email and says you can now borrow at just 2% interest, you tend to get really tempted to YOLO everything on the debt that you could pull out against your stocks and buy more Tesla because stocks only go up. And when banks tell you that a 30-year fixed rate mortgage is available for you at the low price of just 2.8%, locked in for 30 years, you tend to want to buy real estate. Unfortunately, this means we're also heavily subject to what is now being referred to as the Day of Reckoning. The Day of Reckoning is when the Federal Reserve decides, party's gone on too late. Time to take the punch bowl away of low interest rates, and well, that really upsets the party. The last time the Fed tried taking the punch bowl away, we were kicking and screaming so much they had to put the punch bowl back. Yeah, that actually happened. In the summer of 2018, the Fed started bumping interest rates pretty dramatically. We went from 0 to a high of 3% very, very quickly in rapid succession. That ended in 2018. And while that instantly caused a substantial pullback in the real estate market, and the stock market had a pretty bloody November and December until the Fed relented and started reducing the interest rates again, basically putting the punch bowl back in early 2019. Well, now many of us are even more fearful about what could be next, and why what could be next could be worse. After all, we've now pumped trillions of dollars more into the market, and we're now even more addicted to that punch bowl of sweet, sweet low interest rates. So what's the path forward? Well, today, I analyzed a speech from Charles Evans. He's the president of the Chicago Fed, and he gave us his opinions about the Federal Reserve and what to expect. This gives us some updated guidelines, and it really helps us if we're investing in stocks and real estate. So let's just go ahead and pull up the speech itself. I highlighted the most important sections, so that way you won't get bored with, hopefully, I mean, it's still kind of, we're talking about the Fed here, okay? So let's just take a look at the good stuff, and then let's draw some conclusions. Okay, here's the beginning of the boring piece of paper. We don't really have to pay too much attention to the first or second page here, but I do want to quickly note that these are Charles Evans's expectations, and one of the things he does say is that the expectations he's about to talk about are based on and assuming that there will be more fiscal support, that is, more stimulus support coming. And he says here, without adequate fiscal support before too long, I'm concerned that recessionary dynamics will gain more traction and lead to a slower trajectory back. And keep this in mind, when we're talking about a trajectory of recovery, we're kind of expecting stimulus to get us there faster. If we don't have stimulus, then it's gonna take longer, and we're gonna get to keep that punch bowl of low interest rates even longer. So what I'm about to tell you is actually his assumption with stimulus. And if it's without, then we have even more time. And that's what we're trying to figure out, is when is the party gonna end? What time, so we can plan and we can get our last few dances in? Well, here we go. Once we go to about page 5 in his discussion, we get to what he calls a new framework. And he starts talking about kind of test driving cars, and he goes on these rants about how his opinions about inflation work, and he talks about 2018 and 15 and $16 crap. We don't care about that. We want the bottom lines. And here we go. This is what he says. So he believes that inflation is going to gradually rise to 2% in 2023. But before we talk about what happens next, he also says, and this is a good warning to keep in mind, he does believe that at the beginning of 2021, we're going to see some inflation data that actually looks a little bit more scary. And what he means by that is because in 2020, prices fell so much. We had prices fall, and now we're kind of slowly trying to recover, right? Well, what happens is if in 2021 we do inflation readings, let's say right here, and we look back 1 year, we might actually feel like, oh my gosh, we had like 3% inflation. He's actually giving us this warning that don't worry about that. That's not what we're looking at right now. We want to look at that long run inflation. So that was an interesting warning that he gave. And then he gives us his projection in terms of, okay, how long going forward are we actually gonna think the punch bowl is still gonna be out? And his answer's right here. So he says, suppose we hit 2.25% inflation in 2024. That is, we have low inflation of under 2% until 2024, averaged out. And then in 2024, that 2.25% inflation stays. Well, now the Fed is above their favorite, 2% target. And that's something to keep in mind as well. The Fed is trying to get us to something known as an average of 2% inflation. Right now, as a country, we're probably somewhere between this 1.3 to 1.7 range. And we've been there pretty much this whole last decade, probably for like the last 12 years. And so what Mr. Evans here is saying is, let's say by 2024, we finally get inflation to 2.25%. That's 2.25%. Well, he believes we are going to stay at that inflation. That is, the Fed will not increase rates, because once inflation goes up, then they're usually gonna wanna increase rates, and that's when the party's over, or that's when the party starts going ugly. Anyway, he believes we're going to sit at this range and not raise rates until at least mid-2026. If this holds true. And that's the important thing to note here, is he's kind of giving us the calculus here. He's saying if you have inflation hitting 2.25% in 2024, well, then we can just throw on a spreadsheet and average out, okay, what's our inflation over time? And then if all of a sudden by mid-2026, we still have that same inflation, well then great. Then we have this, what they call cumulative average core inflation of their favorite number, 2%. And he even says what this means is if for some reason we see like a crazy inflation reading and it's like, oh my gosh, inflation just came in at 2.5%. He's actually saying, don't worry about that. And he kind of addresses that right here where he says, if you can produce 2.5% inflation in 2024, then you can actually get to an average 2% inflation about a year quicker. Okay, these are really great bottom lines. So let's understand that. And if there's anything you're gonna write down on your investing wall or wherever you put your post-it notes or whatever, this is probably a good thing to write down. So if by 2024, or whenever we see this, right? I mean, this could seriously, it could come early, right? That's always a risk factor. We don't really know. We're only saying like if then. So if we see 2.25% inflation by 2024, then rates will probably stay low through mid-2026. That's a pretty good conclusion right there. If interest rates go up to 2.5%, then we'll see this sort of low inflation. The punch bowl will still be around until mid-2025. That's pretty good. Now, we're not really expecting to see like 2.75 or 3% inflation. Obviously, if that time came, we could always adjust our figures. But something that's really cool that we could do with this whiteboard here, which is kind of like a spreadsheet, because see, when I just do this and I put in, well, what if that inflation comes early? What if we see it in 2022? Well, then the spreadsheet automatically updates and tells us how long we're gonna see low interest rates for. So this is why, if there's anything you're gonna track inflation. And what we're looking for is if we see that consistent 2.25%, we've probably got another 2 to 2.5 years. If we see 2.5%, so 2.5% inflation, then we've probably got an extra 3 years of low rates. We haven't even started seeing these higher inflation numbers yet. So we've got a while to go of low rates. So what does this actually mean for us investing? Well, I think it's almost like redundant to just say buy and hold at this point, because I think most of y'all know I'm a big fan of that. I mean, that's what we teach, obviously, and how to actually get really good deals doing that in the money course or the real estate course, how to get real estate deals, starting with zero, how to become a millionaire. Y'all know about those, linked down below. But here's what we really want to take away from this. Okay. If we're thinking, oh my gosh, the market's gonna crash, do I wanna invest or do I not wanna invest? in my opinion, and this can't be the only thing, you never know, you just never know because the market could crash at any point. But in my opinion, if we're really looking for the biggest, fattest catalyst of the market crashing, it's gonna be when the Fed comes in there and goes, "Party's over, boys and girls," and they take the punch bowl away. That's when you know that you got problems. But they're basically telling you, hey, we're gonna set a clock next to the punch bowl. Wouldn't you wanna keep your eye on that clock? In the meantime, you got multiple years left to invest. I mean, his own accord here was that you really got until 2025, until 2026, before they're even gonna start thinking about raising rates. And honestly, my expectation is that we're gonna see low rates this entire decade. That maybe 25 and 26 will come around and oh, that's it, we're taking the punch bowl away. And then all they really do is they take like a little cup out of it and they walk away. And they're like, seriously, that's all you did in terms of raising rates? So even though it seems weird that the Fed is printing money like crazy, this could potentially be I hate to say new normal because I don't even really believe that it would be a new normal because low rates like this seem weird. But then if you look at Europe, it's a new normal. They've had deflation for the last 2 months and they've basically been suffering and struggling, finding it impossible to create inflation. In fact, that's another thing that Charles Evans says in this, is he actually says the longer you remain at 0% interest, the longer you actually encourage inflation to stay low. Like, how twisted is that? Because when interest rates are 0, we're usually thinking, oh, that means easy money. People can just go borrow and spend like crazy, and that's gonna cause inflation. That's the theory. But the longer you stay at what they call the effective lower bound, the ELP, the more you actually reiterate people's expectations for low inflation. And so prices ironically stay lower. This is why I think we got like a decade of low rates here. So when it comes to investing, I'm a big fan of, you're probably better off getting in and then waiting than waiting to get in. You might have to replay that. But anyway, that's my course. So when people ask me, hey, Kevin, what's your course of action? How are you investing? What's your game plan? This is it. I'm having fun at the party. I'm buying stocks. I'm buying real estate. I'm gonna be careful. I'm gonna buy deals under market value. I'm going to limit my debt. But in the meantime, I'm gonna keep my eye on the clock because it's like every other week the Fed keeps telling us like they replace the small clock with an even bigger one and they're like, hello, have you seen the clock yet? Like, we got time, which is good, but the clock is ticking. So keep that in mind. Thank you so much for watching. Get your life insurance, get your 2 free stocks, links down below. Check out the courses and the special coupon code below. And folks, we'll see you in the next video.